Good day, fellow investors. A very interesting business to look at is Euronext, the European stock exchange, because as you'll see, there is a lot of quality, and we can call it even a monopoly, because once you build it, it's very hard for a competitor to take away business from a national stock exchange. The company is now in some countries in Europe. They have been growing through acquisitions. The last one, the Italian stock exchange, for 4 billion. And if you look at their numbers over the last decade, revenues 3 times up, perhaps even more important, EBITDA margins going from a crazy number already of 42% to almost 60% recently. High margins means high quality business, and even if there is a slowdown in revenue, in growth, they would still be very, very profitable, which then allows for other acquisitions, etc. Plus, if we look at the current financial environment where we are living it, it's one of money printing, and that's the only solution people know these days. The current bond market is $140 trillion, just growing and growing and growing, and we can see the number of bonds listed went from 5,000 to 57,000, which is insane. And the trend here is clear. We are living in a debt cycle. It will burst one day, but the next recession will again be solved by printing more and more money, and therefore, when it comes to such situations, a stock exchange might benefit again from increased financial activity, increased assets in the bubbles that are created, benefiting from inflation that will eventually come back again, and they have this diversified revenue stream. Sometimes something will be better, something will be a little bit worse depending on the environment, but for now, and I think in any environment, they will keep making money, they will keep growing over time as they acquire, as the financial assets environment grows. Plus, they have done that already in the past, increasing revenue, increasing proportionally net income, which is another sign of very profitable business. Plus, there are also buybacks, so earnings per share grow a little bit faster than the standard growth, and we are now at 5–6% yield on the current stock price. Of course, they are growing using debt. They went from a no debt company to having 3 billion euros of debt. However, they also have a lot of liquidity, as it takes time for all those transactions. They have this liquidity pool that counters on that interest on the debt. To conclude, you want these monopoly businesses. These stock exchanges are very, very interesting. They have diversification. There would still be, of course, an effect of less new IPOs, less new bonds, etc., but could be countered by increased volatility, more trading. The yield is not stellar, but not bad for what is a monopoly business, and you have to see how that fits your portfolio. P ratio, again, somewhere in the middle with 17, better than the S&P 500 at 27, not a pure value investing. And then we have growth from the financial environment, from acquisitions, from money printing, and therefore I think it's a good, interesting business to put on your watch list. If there is a slowdown, again, like we have seen a year ago in Europe, you might get this now already at a P ratio of 12. Now it's 16, 17, but could again come back, and therefore I say put it on a watch list and watch. It is a monopoly. It will likely be there in the next 5 to 10 years, growing on increased trading, increased financial activity, increased money printing. Let me know what you think in the comments. Thanks, and I'll see you in the next video.